I'd like to thank everybody for joining me today. Today, I want to talk about charitable planning options. This is a conversation we usually put off until the end of the year when we're trying to make those last minute contributions before tax year ends. But this is something that happens throughout the year. And if we're doing our charitable planning with a little bit more intent, we can get a better result. The biggest thing about charitable planning, there are a lot of options on what we can do. If you think about what can you give, well, you can give almost anything. You can do cash, you can do business ownership, publicly traded securities, real estate, copyrights, royalties. All of these things you can give to a charity if it's of value. And if it's of value to the charity, of course, they're going to be happy to take it. And it's a benefit for you because you can create tax deductions as well as help your other planning. As you start going through, let's talk about the ways to gift. Well, the easiest is a direct gift of property. And this is what most people think of, if they want to donate to their church or to a school, they just take assets and transfer it to the charity and they get a fair market tax deduction. So you value the asset, fair market value, you give it to the charity, and you get the deduction. Now, the problem with this is most people will just give cash to the charity. But let's rethink this a little bit. Now, if you were to, let's say you want to give stock, Google stock, and it's appreciated. Well, if you give the Google stock, but hold on, you decide you don't want to give it because Google may go up again. Well, here's what you can do. Instead of paying the capital gains on selling that stock and giving cash to the charity, donate that Google stock to the charity, get your tax deduction. You won't have to recognize capital gains, and you can turn around and buy your Google stock at today's price without that capital gain built into it. So you can be a little bit more intentional in your giving by giving appreciated assets instead of just cash. To the charity, they're happy, they can sell it and they get to use the money. They just have to convert stock to cash. One thing that's newer is using qualified charitable distributions. I talk to a lot of older clients that are taking their required minimum distributions and they don't want to take them anymore, or they don't need them. Well, they can do a direct IRA to charity transfer. If they do that, they don't get an extra charitable deduction because they're going to just exclude that from their adjusted gross income. So they can, take that out of their, direct from their IRA to the charity. The charity says, thank you. You don't have to put it into your taxable calculation, but there again, you don't get a deduction. Now, it's got to come from an IRA. The owner has to be age 70 and a half or older. And the maximum amount this year is 108,000. That will go up each year because it's indexed for inflation. And it counts towards your required minimum distribution. So it's a great way to, there again, give to charity, but do it more intentional. One way to leverage assets. A lot of times our clients will have assets that are underperforming or assets that just aren't doing everything they want. Well, here's what we can do is we can take those underperforming assets, think about CDs, savings accounts, maybe underperforming investment accounts. We can take that and put it into life insurance. Now, why would you put it into life insurance? Well, when we move it over into the life insurance, when we buy that life insurance policy, it's going to create a death benefit. But let's just stop and say we want to give to charity upon our passing. Well, during life, out of that life insurance policy, if we're building cash value inside that policy, you can use that cash value for your lifestyle needs. Take money out to run your business, be able to access it for long-term care, take trips, give gifts to your kids or grandkids. You've got access to that policy while you're alive, and why you want to continue to have access to that policy. Now, here's where we can leverage that gift. Since we're taking those underperforming assets, when we take the death benefit, we can split that death benefit partially to our heirs and partially to the charity that we want to benefit. Let's take, for example, let's say we had that CD and the CD is worth $100,000. We put that CD into this life insurance policy. And just for ease, let's say that life insurance policy had a death benefit of $200,000. Well, we can still give $100,000 to our heirs, but we can now leverage this gift and give $100,000 in addition to the charity. So if you've been able to use this policy during lifetime, and at death, we're leveraging our death benefit to do more charitable giving than we were going to do originally. So it's a great way to create a leveraged gift. Next, let's look at what I think is called charitable giving plus. Charitable giving plus something else. And let's look at using what a charitable remainder trust can do. With a charitable remainder trust, if you have appreciated property, and let's just say you have a rental home. You've been renting this home out for years and years and years. There's little to no basis in there. So if you sell it, you're going to have a taxable gain. Now you decide, I'm done fixing toilets. I want to transfer this and get rid of it now. So instead of paying tax on the gain or doing a 1031 into other real estate, you can set up a charitable remainder trust. And with this charitable remainder trust, it's going to do a few things for us. One, when we transfer this money, this property into the trust, the day we do, you get a charitable deduction. Once that property's inside of the charitable remainder trust, the charitable remainder trust can sell that asset income tax free and reinvest those proceeds inside the trust. So now the trust is taking an illiquid piece of real estate and converted it into a liquid portfolio that you can now receive income on for the rest of your life, the rest of your joint lives for husband and wife, or we can do a set number of years. That income stream coming back will be taxable in most cases. And that's okay because we got out of the tax and created that big tax deduction on the transfer of property. Now, when you die or when you and your spouse passes away, whatever's left in the trust goes to the charities that you pick. And that can be a 501c3 charity or it can be a donor advised fund. What I like about that being a donor advised fund is now you can help your kids continue your charitable giving, or you can split it up between, different charities that have been important to you. So maybe it's going to Red Cross to help things there, Wounded Warriors, Donor Advised Fund. However you want to split that up, you can. The nice part about this is you have now what I would call a charitable pension for the rest of your life or your rest of your joint lives that you can live on. And then at the end, whatever's left goes to charity. So it's a nice add-on to a lot of your retirement years planning. The reverse of that would be a charitable lead trust. Now with the charitable lead trust, what I like is there again, we have property. Now with this, we can use cash because it's a little bit different. When we set up this charitable trust does not get to sell property inside of it and treat that reinvestment as income tax free. Whatever happens inside this trust is taxable back to the owner that put it in. So they're going to receive a K-1 from the trust every year that says, here's the investment gains or losses inside that trust. But here's the nice part about this. We transfer this property into the trust, and we're going to set this trust up for a number of years. For a set number of years, that income stream is going to be paid to the charity. So let's say you put $1 million in there, and you want 5% per year going to your charity, whatever charities you name. they're going to receive that 50,000 per year. At the end of the trust, whatever's left comes back to you, and you can put that back into your portfolio for retirement or passing on to your kids or whatever you want it to be. So charitable planning can be done intentional. It can be used whatever assets you want, but it creates a nice opportunity to plan throughout the year. So I appreciate everybody getting on today. If you have questions, reach out. If not, we'll talk again next week. Thank you.